who was for years, I think more than a decade, in investment banking with Goldman Sachs, Chase, Lehman, as an analyst and also as a manager. Has been a very widely published analyst and expert on the banking system, banking history, and published in both as a speaker and also in leading newspapers in the country, and has also written, if I'm not mistaken, something like 9 books.
I'm on my 7th.
Seven books on the subject, including the award-winning Other People's Money in 2004, and the most recent one, All the President's Bankers, and the forthcoming Artisans of Money, about the central bankers, the history with the central bankers, and is also in the middle of a number of meetings with officers of Congress right now. So let me start, Nomi, by asking you, you've written an analysis piece on 2017 and what you expect, in which you say that the stock and bond markets in the United States may crumble by the end of the year, that there will be a large upsurge in corporate defaults, and I think you give the figure that there already was quite an upsurge in 2016, and talk about the European banks and the major losses that some of those banks have been reporting. Do you think these events threaten another bank panic like 2008?
I think that because the 2008 crisis or bank panic has not really been resolved, what has happened is it's sort of been shifted forward. And by that I mean when we had the crisis in 2008 and we had all the interdependencies between the largest banks, not just in the U.S., though prevalently in the U.S., but then throughout the world, the solution to that was for the Federal Reserve to cut rates to 0 and launch a quantitative easing program, and to basically expand that program not just in the United States to help liquidity and credit flow here, but throughout the world. So there's been an almost decade-long coordinated period of elevating the markets and helping banks maintain liquidity and keeping reserves from these banks that don't then get on-lended into the main economy, or at least the lower echelons, or the individual citizens or smaller businesses of that main economy. And that's really what's been happening almost for a decade. So at some point there will be a give in that strategy. We've already had the Federal Reserve raise rates now by 75 basis points beginning in December 2015 through March of 2017. So effectively at this point 25 basis points per year, which isn't a very big number. But what that is doing, while other central banks are keeping rates at either negative or close to 0, like other major banks, so still keeping the equilibrium of zero-cost money throughout the world, is it's edging the possibility of more defaults to creep into the system. So on the one hand, the reaction of markets has been to all this cheap money to go up. There's nowhere else for money to go. So bonds are not returning any real interest, and high-grade bonds certainly aren't. So this money's been pushed into the stock market, and it's kind of had a self-fulfilling bubble quality to it. But when these rates start going up, all the debt that's been created during this period starts to have to repay at potentially higher levels than it wanted to, or it expected to repay. And so all the corporate debt that's been issued, all of the money that's flown throughout the world, all of a sudden has to consider retracting. And we've already started to see that since the 2015 hike in the Fed rates, which is that we had higher default rates in corporates and also in US dollar denominated corporates throughout the world than we've had in any of the years since the crisis started. And then we had a second bout of that in 2016. So we have the defaults in the corporate world increasing, almost in tandem with rates being raised. And so at some point that's going to create a situation where those companies start to have difficulties repaying, particularly in emerging markets outside the United States. That's going to hurt their markets. When those markets start going down, it starts to hurt the main markets. It starts to hurt the US market because it comes back as confidence and credit starts to crumble throughout the world. It might start peripheral to the US, but then it comes back back to the U.S., and the same thing with Europe. There's a lot of volatility in the European markets, even though they're doing very well stock market-wise, because the process of the European Central Bank has been to keep rates at negative and to continue to buy securities and to basically flush the system with money. When and if that starts to become more expensive, then you will start to have corporate defaults increase more in Europe and so forth. So we're really set up in a way at a much more dangerous point than we were before the financial crisis of 2008, because now the world is sitting on a tremendously larger, basically a larger amount of debt. Right now, debt to GDP in the world is about 3 times, or there's $325 trillion of debt in the world relative to GDP. It was less than 1 time debt to GDP before the financial crisis started. So it's elevated quite a lot throughout the world. When it starts to cost more.
1 to 1 to
or a little bit more than 1.
25 to 1?
Yeah, a 3 to 1. So basically,
Yeah.
basically the ratio since before the crisis to after the crisis has almost tripled. And we've seen that even in the U.S. I mean, it's gone from, it's over 100% now almost, or close to 100% of debt to GDP, and that's not unique to the United States. And of course, in countries like Greece, it's 160% or 170%. This has all taken place because debt has been cheap to issue. When debt becomes more expensive to issue, or you have to repay debt that has been issued at a higher amount, but you don't have real growth to compensate for that, you don't have real profit to compensate for that, that's when markets start to get wobbly, that's when credit starts to tighten again, and that's when this entire quantitative easing central bank coordinated process of keeping money so cheap and so flowy through the banking system and then out to the markets starts to become much more shaky. And I think that's what we're going to have by the end of this year, because now we're just in the sort of year-ish period of the Fed raising rates, and other central banks have not. I mean, somehow, Mexico has. Some countries have done it in tandem because they want to keep their currencies somewhat in a band relative, or an unofficial band relative to the dollar. But for the most part, it's still cheap money throughout the board. But again, as it creeps up even a little bit, everything becomes more expensive, everything becomes tighter. And that's when what has happened to the markets and to the banking system in terms of subsidies starts to crumble. And I think we're kind of at that breaking point. It might be after another 25 basis points, maybe another 50 basis points as the Fed goes there. But we're at a point where debt just starts to become very expensive, and then defaults start to come in.
And you've been talking, you're talking this week to number of people on the Hill about Glass-Steagall. What's the importance of the role of Glass-Steagall? Is it in preventing this threatening situation, or do you think it's just a question we need it in order to get the banks in order for them to do sound banking?
Well, I think it's both. I mean, first of all, when we had Glass-Steagall repealed in 1999, it unleashed a tremendous amount of mergers throughout the banking industry. So we already had big banks dominating a lot of trading and a lot of issuance and a lot of deposit holding anyway, because we had had a 1994 Act where they could go across state lines, and we had a 1999 Act of repealing Glass-Steagall, so they could now connect to insurance companies and asset management firms and investment banking all within one roof, connected to commercial banking or deposits and loans. So as that was all happening, banks were consolidating. They were becoming either bigger, if they were a sort of supermarket commercial bank like a JP Morgan Chase or a Citigroup, where they chose to merge a sort of classic commercial banking company with an investment banking company, or they became more leveraged, like what happened with Goldman Sachs or Morgan Stanley, where because they didn't merge with a bank and have that extra balance sheet, those extra deposits from which to leverage new securities or trade or bet and create more risky opportunities for themselves in the market. So they chose to compete against these supermarket banks that were created in the wake of Glass-Steagall repeal by leveraging themselves even more. That's what Lehman Brothers did before it imploded. That's what Bear Stearns, both of which I used to work at, did before they imploded. So there's sort of competition and leverage that was unleashed by Glass-Steagall being repealed. What that created was this hunt for, as it turned out in this period, subprime loans, which could be leveraged into securities, and they could be merged into new securities and CDOs or collateralized debt obligations, where there was all sorts of layers on top of these individual loans, but all of that layers was leveraged within a security, And then the banks themselves were borrowing more and more to buy or create more of these securities, and so they were leveraging the balance sheets ever more. So you had leverage on the balance sheet, and you're leveraging the security.
Just so that people understand who aren't familiar with the language.
Yes.
By leverage, you mean putting a lot more debt on their balance sheets in order to make their assets seem more profitable.
For book leverage, you're
Right.
putting more debt. You're basically borrowing money in order to create securities, and that could be by borrowing money to buy more loans in order to create securities out of them and then resell them. It could be borrowing money to get more involved in the derivative markets. It could be a lot of different things, but you're effectively, it's like if you were to go to, say, Vegas and bet on a table. You can either do it with your $10 in your pocket or your $100 in your pocket, or you can use your credit card and you can sort of leverage up. You could be like, I want an extra 100, I want an extra 100, and I'll go to the machine and I'll get some. And then you keep on sort of doubling, tripling, quadrupling, and 20 times down on one bet. So you lose 20 to 1 instead of 1 to 1 if it goes against you. And that's basically what happened in the markets on the back of these subprime loans. The only reason that was able to happen was because of the structure of Wall Street that enabled banks to take loans both off their own books and to buy them onto their books and repackage them and resell them into more complex, more risky securities. If Glass-Steagall had existed, they would not have been able to do that. If Glass-Steagall had existed, banks would not have borrowed and been allowed to leverage as much in competition with the banks that had the loans to begin with in order to do that. So the repeal of Glass-Steagall allowed the crisis to happen because it allowed this instability in the banking system. It allowed banks to become bigger. It allowed them to become too big to fail after they began to implode, and the Treasury Department and the Federal Reserve and the government decided, we need to basically save the economy, save citizens from the implosion of these banks. And so we're going to plug the holes. We're going to plug the holes with TARP. We're going to plug the holes with bailouts. We're going to plug the holes with lending more to these banks because they can't even get any money because they've sort of shot what they've had into these bets, into the market, and that's not working right now. We'll give them zero interest rates so that money can come more cheaply back to them. All of these remedies they just talked about a little bit before were really created to subsidize a very flawed system from a structural perspective. And so now what we have is this flawed system that never got readjusted back to something that would be more stable for everybody. But now it's elevated by all this extra subsidy and extra debt that was thrown in to keep it from completely dying in 2007, 2008. So that's why the risk of implosion right now, the sort of downside, is much greater because we never really bothered to dissect these deposits and these loans from all the securities that were created and can still be created, and the leverage that can still be created upon them. So now it's almost more imperative to reinstate Glass-Steagall, to bring back that separation, because we're actually on the hawk for more money. The books, for example, the Federal Reserve are now at $4.5 or so trillion, and that they've effectively taken, they've increased their reserves from these banks to the standpoint of excess reserves that banks don't even have to put at the Fed of like $2 trillion or so dollars. So that's $2 trillion just off the top of our economy that effectively was created in debt by the Treasury Department, went through the primary dealers, these biggest conglomerate banks, and was sold back to, or given basically back to the Fed to receive interest from the Fed. So there's this sort of triangle of just debt and money moving around doing absolutely nothing. That's only $2 trillion of it, and that's only the United States. There's mortgages and other things on the Fed books. The same thing has happened in Europe. The same thing has happened in Japan. There's just been this circle of debt creation by governments to go through the biggest banks and go back to their central banks without ever going into the economy. And so that's a problem. And the reason these big banks need to be split up is so that they don't have to have emergency money and excess reserve at these central banks in case their risky bets go south again, which is why they have it there, why they're not necessarily putting the rest of that into, again, the sort of individuals or citizens part of the economy. They would have to do that if they were split up like they were under Glass-Steagall into banks that just dealt with deposits and loans, and banks that could trade all they wanted to and buy and sell all the risky securities they wanted to, but on their own dime, and not be bailed out by the government if they fail.
So the problem has not been, as they claim, a lot of regulations that were put on these banks, but rather the huge money printing bailouts and money printing that went into these banks
to save them.
To save them since the crash, and the way they were able to expand and use their deposits before the crash after Glass-Steagall. It's not that they've been regulated as they now claim. That's
no, in fact, I mean, they've barely been, well, first of all, the big six banks in the U.S., JP Morgan, Chase, Citigroup, Bank of America, Wells Fargo, Goldman Sachs, and Morgan Stanley, and that's a combination considered big six, both because of their asset size as well as their sort of risk profile, and that they are under Dodd-Frank, but also in general more systemically risky banking institutions. They're 21 to 25% larger in terms of their asset size than they were before the crisis. So, you know, it's hard to argue that regulation has kept them from growing. Their deposit size is somewhere between 30 and 40% greater on average than it was before, collectively, than it was before the crisis. So it's really hard to look at these institutions and say they were having problems sort of growing due to, you know, punitive regulations. What they have had problems doing is, one, it relates to one of the regulations or one of the titles, Title II of the Dodd-Frank Act, which asks them simply to not even do anything in the case of a new emergency, but just to write what was called a living will, so that in the case of another financial crisis, a derivatives implosion, a war that squeezes credit, whatever it might be, they have an exit plan. They have a way of unraveling their books, or at least imagining how they would do it in a situation where the markets were to, say, squeeze up again, or liquidity was to dry up again, and show that under different scenarios to the Federal Reserve and the FDIC. They were unable, 7 of the 8 largest banks in the United States last April, when these living wills were due to the Fed and the FDIC, either didn't pass mustered with both the FDIC and the Fed, or with one of each of them. The only one of those 8, Citigroup, passed. And Citigroup has a lot of problems of its own in terms of loans, and was at the crux of really the beginning of the financial crisis to begin with. So our largest institutions couldn't even pass the living will / I call it the imagination test for what could happen. So you can't call that a dangerous regulation. You can't. Well, you can, but basically, this was a statement that said, you know what, just tell us what would happen, so it's not on the dime of taxpayers, it's not on the dime of citizens. The Fed doesn't have to go into negative rates forever to save you the next time, and they could not even do that. So the idea that we're over-regulating in any way the banking sector since the crisis is really rather ludicrous. Nor are we tightening their ability to provide loans. They have $2 trillion worth, again, of excess reserve money sitting at the Fed doing nothing. They can lend it out if they want to. Nobody is stopping them. There is no regulation whatsoever at all that says they have to spend or keep all of that extra trillions of dollars at the Fed. So that's self-choice.
So, just to interrupt you for a minute, then what Steve Mnuchin, the Treasury Secretary, said when he was being confirmed that restoring Glass-Steagall would cut back on lending, would cause the banks to cut back on lending. This, clearly you're saying that's not true.
Well, I mean, just logically it's untrue, because if you had to have banks make a choice, you know, splitting themselves up and making a choice as to where they wanted to allocate their focus, as what happened in 1933 when Glass-Steagall was first introduced. And it was passed by a bipartisan Congress and by Republican bankers who are very much into the concept of reducing the risk in the system to create more confidence in citizens, to basically allow them to deposit more money with their banks. I mean, it was self-interest, but it was kind of a logical type of a self-interest. If that happened again, and banks had to make that choice of spinning off not just into a sort of connected arm of trading relative to their main bank, but an actual separate company that's just nothing to do with it, which is what Glass-Steagall 1933 required, and they chose, let's say, to just focus on their deposits and loans, they would by definition have to lend more, otherwise they wouldn't be as profitable. So in fact, it would be Glass-Steagall that would create more lending into the economy, just by sheer survival of the component of the bank that would choose to, you know, keep the deposit and lending arm versus the one that would do the trading side. So, and when I say arm, I mean separate company. So that's not a good argument. in terms of a reason to not reinstate Glass-Steagall.
So what do you think is the way that Republicans and Democrats can join on what you're proposing with Glass-Steagall, and with regard to the Dodd-Frank Act also? Glass-Steagall is now introduced in the House. It has nearly 40 sponsors. But from the Republican side, there is this attack on regulation, and they're being told by their leaders that they have to look for legislation to remove regulation from the banks. How do you think that this can be bridged?
Well, I think if we go after, or not go after, if we go back to what happened just in the crisis relative to the bailout moments, where both Republicans and Democrats were faced with a very crisis banking system. It was really more Republicans who didn't want to necessarily vote for bailing out those banks. There certainly a number of Republicans. I mean, there were people on both sides who didn't feel that the bailout was the responsible thing to do, and I agree with that. I mean, there was other ways, I think, much more cheap ways that would have not incurred so much debt onto the U.S. books, and also, you know, this whole global proliferation of debt that I've been talking about. I mean, there would have been very simple ways to fix that entire thing, and I wrote about them in It Takes a Pillage in 2009. But that didn't happen, and so what happened was Republicans and Democrats and their constituents were basically on the hook for supporting these institutions, and not just in the bailout, but then in all of the years of very low interest rates where savings of the voters in their communities are unable to achieve the earnings or the returns that they had in the past when rates were higher, and just a lot of different things happened in both Republican and Democrat constituencies that were hampered by the remedies that were put in place to deal with the crisis that had to do with the fact that our banks were too big to fail, and the moral hazard that was associated with that, which has not gone away. So I don't think the term, it's almost, if we start to sort of debate the term regulation or deregulation, we're missing the sort of structural element of what the banking system looked like by commingling deposits, loans with riskier activities, and that if it didn't look like that anymore, there would actually be less need for regulating smaller things around the edges. Now, you start to have to regulate small things around the edges of the banking system when the banking system itself is structured in such a way that it can incur such great damage onto the overall economy. So from the standpoint, even historically, of why both Republicans and Democrats wanted the Glass-Steagall Act and almost collectively voted on both sides for the Glass-Steagall Act of 1933, that was because both parties believed there should be more confidence in the banking system, and that it shouldn't be the government's concern that banks were going to implode or trust companies were going to implode and we were going to have another Great Depression. Nobody really wanted that, which was why it was such a bipartisan vote. Now, equally, it was a bipartisan vote to repeal Glass-Steagall in 1999 because we had had so many good years of basically not having financial crises that I think you know, Congress people on both sides of the aisle forgot why, and said, all right, well, the world is different right now. We can repeal Glass-Steagall. These banks should be bigger and allowed to operate in more different types of services, because that's how the U.S. is competitive with the rest of the world if the rest of the world is doing it, because that's what Europeans were doing. That's what European banks were doing. And so there was all these competition arguments that were coming both from the Republican side and the Democrat side, which forgot history. The history of why Glass-Steagall existed to begin with, and the fact that we had a lot of stability in the system for most of the decades that followed that. It was only when chinks started happening in that regulation around the edges that we started having more mini crises and ultimately the larger financial crisis in 2007, 2008. So it shouldn't be a partisan issue. It should be something that both Republicans and Democrats want to avoid, another financial crisis. And I would hope both sides look at the history of what this country did, both sides of the aisle, when we had a major financial crash followed by a depression, how it was stabilized after that, where it broke down and why it broke down in the last crisis, and that we're actually at a very dangerous point right now if we don't restructure the financial system. And if we do, if we bring back Glass-Steagall, we don't have to have as many arguments about regulations anymore, because financial services companies and banks will have picked a side. One side will be lending into the main economy, corporations and so forth. One side will be trading more from a riskier perspective, and that's how it was, and that only changes the structure, which enables us to be healthier from a risk standpoint going forward.
Now, you were an investment banker, especially at Goldman Sachs, in the period in which you described this increased leveraging going on, and the commercial banks coming over and buying investment banks and essentially putting the deposits into the mix of all this speculation. What did you see going on there? And you obviously have a very different career since then, as not only as an author and an expert, but as an advocate for the kind of bank regulations epitomized by Glass-Steagall. What made you shift?
Well, first of all, there's the technical aspect of what happened, what was going on inside, and there was what was going on inside with respect to how banks were being restructured and leverage was being required or demanded by some of the investment bankers. And at Goldman, where I was in 2000 to 2002, which was after 1999, so it was just after Glass-Steagall was repealed, and there was this big sort of force on Wall Street and throughout the world as well for one of two things to happen: either big banks to find investment banks to merge, and it was basically called having balance sheet, because at the time the way you could get more investment banking business, large fee, chunky business, was to say we have the ability to both lend to you and to do your debt issuance, and to find a way for you to buy the company you want to buy, and to do all of these sort of investment banking activities. We'll also lend to you. We can only do that if we have a big enough balance sheet, if we have deposits, and we have loans that we can use as collateral in order to be able to lend to you and therefore get your business. Now, banks, investment banks like Goldman Sachs, where I worked, and Morgan Stanley, chose not to merge with the big commercial banks. They were considered a little bit inferior from an ego perspective. They weren't as sleek. They didn't have the great systems. They didn't have the smartest people. I mean, it's a sort of inside chatter. And so you didn't want to have to deal with merging with this large, sort of chunky commercial bank and deal with personalities and old systems and antiquated sort of combinations of old form finance. The way to get around that was to lobby the SEC, the Securities Exchange Commission, regulators in Washington and so forth, to allow more leverage to the investment banks. And that conversation was going on often between 2000 and 2002. I left after that. It continued after that. I mean, I do write about that in my books. But it was a conversation all of the time. It's like, we just lost this business to JP Morgan Chase because they have balance sheet. We just lost this business to Citigroup because they have balance sheet. And so there was this jockeying of position just in general for Wall Street fees that came out of Glass-Steagall repeal, and that created this whole idea of more leverage everywhere on the dual banks and also on the investment banks, and that ultimately, as we talked about, came in the crash. So I'm on the street, and a lot of the products that we also were creating in investment banks, again, to compete with the bigger fees that the conglomerate banks were getting because of their structure. We're getting more involved in credit derivatives and getting more involved in things that we now know as CDOs and CBOs, collateralized bond obligations, taking little pieces of debt, mixing them together, and then issuing securities off of them, which mostly had AAA rating and had a little bit of BB at the bottom. So we basically layered these securities and put a lot of bad debts into one home, and then sliced it off into pieces that we could then sell. And there was a lot of that going on. So if I'm sitting in, which I was, say, monthly meetings in the credit department, talking about our trading books at Goldman and what was on the books and what we needed to sell, if we had a piece, we call them pieces of a BB bond or something like that on someone's trading book, and the lower the grade, usually the more money you could make out of it, because the spread from buying to selling was greater. So you could pick a sort of price along the way, and if you could find someone willing to pay that price, you could make more money. There were story bonds. A AAA a treasury bond isn't going to make the same kind of money, but a double B bond can, if you can sell it. If you can't sell it, you can't make money off of it. So the idea was, well, how do we get rid of this sort of piece of crap double B? And one way to do that is to tell a really good story and just sell it straight out. The other way to do that was to wrap it into a CDO or a CBO and just mix it with a whole bunch of other kinds of debt. And either way, you could price it at as high a level as you could get away with. And so there was a lot of conversations about those axes, or those axes, or these pieces that were hanging around that we needed to get rid of. And it wasn't just the Goldman, of course; it was throughout the street. And so that was going on. But what that meant was, as companies were basically now having problems with their own debt and their loans, because we were entering a recession during that time, and we had scandals coming into the corporate sector in the form of Enron in the energy sector, WorldCom and other companies like a Global Crossing in the telecom sector. All of these were starting to both have scandals and have their own positions and their connected, more complex securities that banks had worked with them to create. Were all kind of falling apart. So it was one of my jobs to look at how the books, the loans, or the debt on the books of some of these institutions, perhaps before scandal or perhaps during, but basically were falling apart, and how we would restructure them into some new security. And so the only way to really be fair to the client buying that new security would be to explain to them the risk of buying that security. And there's a lot of leeway in that risk. What I used to do at Bear Stearns, which I created an analytics department at Bear Stearns, which no longer exists in London, was I wrote a lot of models to quantify that downside risk. Like, what happens if there's a credit event? What happens if there's a default, whether in a little piece of a bond or a little loan or just something along the way of a larger security packed with lots of different little things, how that would impact the price, how that would impact its ability to trade. I couldn't really do that at Goldman because it really wasn't something that was wanted. Yeah, it was just not something that was, we had we had department money allocated to, or time allocated to. It didn't make money. And a lot of what we did at Goldman, or had to do at Goldman, was to report how much money we made on everything we did. And if you're telling a client what their downside risk is, arguably you're actually giving them more of a reason to sort of trust you long term. But if you're doing that, you're not in the short term making money. You might even not make a sale. And so there was a bit of a moral line for me in terms of not being able to do that, not being able to explain that. I mean, that was one of very many things. I was there also during the period of, well, that was all happening of 9/11, which happened, of course, in late 2001. And it was also around the time where Enron was imploding, and there was a lot of, the external shock of terrorism, as well as the really, it almost was a cover in a way to what was happening to different corporates, and how those relationships with banks were imploding from just a financial standpoint. And I think that shock of being at Goldman Sachs during 9/11 and being on the fourth floor, which was a trading floor where commodities were traded, where Gary Cohn ran the energy, along with other areas, and the idea was to keep trading through smoke and through whatever was going on, because we didn't know that it was a terrorist attack in the beginning of it. We just knew that some planes had hit buildings, had hit the World Trade Center, and so the mentality of Goldman and of Wall Street was, okay, well, if planes hit the World Trade Center, then there's going to be some fluctuation in the price of oil, because oil fuels planes, and planes hit something and there's a major shock going on, so we need to keep trading. And so that idea of just continuing through when there was other sort of scarier factors going on the outside, and at the time that trading was being required, it wasn't, we didn't know. But still, I think that was one thing for me that was a final sort of turning point in how I considered the integrity of the banking sector as it had become, and as it had evolved over those few years, in terms of really hiding the values of securities and of the potential risk of them and the potential risk of defaulting, which ultimately was at the crux of the financial crisis of 2008, 2007.
Let me ask you about, as a historian, you've written, I know one in particular, very fascinating book called All the President's Bankers, came out, I think, in 2014. And in that, it's kind of a financial history of the 20th century in the United States. Very comprehensive, really fascinating. You trace the relationship essentially between Wall Street leaders and presidents throughout that period of time, and you say that the character of that relationship changed in a very definite way when JFK was president. What happened there?
Okay, so up until that point, and we're basically concatenating a lot of history, but after primarily the crash in 1929, through the period where JFK was president, and Glass-Steagall happened to be prevailing as well, there was a kind of collaboration of the bankers that ran a lot of the Wall Street banks, the larger banks, and the presidents. There was a sort of a shared patriotism. Which, we think about bankers potentially always being, a little greedy, a little sort of for themselves. But there was a period after the crash and during the Great Depression where that really shifted, partially because we had a world war. The bankers were involved in various types of advisory capacities, but they also had this shared both patriotism and I think fear of having another depression and many other things, plus regulation that bonded them in a sort of meaningful way. And then those people started to change. These were legacies of individuals and families who had gone through worse times, and their sort of offspring, or the new generation, people like David Rockefeller and Walter Wriston, who ran Chase and National City Bank, which is now Citigroup, combined started to have more sort of globalized ideas of where they wanted their institutions to go. And the power that they wanted their institutions to have relative to the decisions of the government. So for a time they were somewhat collaborative, and then they started to become more combative. And there's a piece, I think it was 1961 or 62, I talk about in the book in Life magazine, where there was a series of essays or letters between David Rockefeller and JFK, where they really sort of butted heads in terms of where they believed U.S. policy should go, U.S. monetary policy should go, and it was a very sort of public confrontation, and it was done with very nice language, and it was all very gentlemanly, but it was sort of beginning of a confrontation where the bankers were starting to sort of elevate themselves and what they wanted versus what the government wanted and what JFK wanted, because of course JFK's idea of the world was that if countries throughout the world could become themselves stronger, and they were economically and financially, and they were partners with the U.S. economically and financially, then it would sort of be elevating the entire world. And that's how he pursued trade policy. That's how he pursued his idea of banking policy. Whereas the bankers were more like, we want to be able to lend to emerging markets and get really high returns back on what we're lending. We want to go into, potentially the Middle East and figure out a way. And this happened a little bit later to receive money off of oil in a different way. And so there was a lot of visions that these men had that were in contrast to what JFK wanted to do. And there's this photo, which I didn't have photos in the book, but when I was going through archives, Kennedy archives, and there's one particular photo where Kennedy, who's personable, sort of good-looking fellow, and a lot of very sort of relaxed in many of his photos, had this one where he's standing with a bunch of bankers in New York City. I think he used to stay at the Carlyle Hotel, the presidential suite in New York, and he's literally like tight with his arms close to his body and just sort of looking very, very uncomfortable. And so I thought that was very indicative of, a picture says 1,000 words, or reflects 1,000 words of his just discomfort with what who he was and where he wanted to take policy, and who Rockefeller and Wriston were and where they wanted to take policy. And that's really when it started to break down. And then subsequent president, Nixon didn't have very good relationships with them either. In fact, when Nixon went off the gold standard, it wasn't, it's widely blamed on Nixon, because he was the one who went on TV and talked about it. But in reality, it was bankers who really wanted the dollar to basically float and not have to be constrained by gold or pegging it to gold. And they basically pushed Nixon to do that. So all this evolution was about really bankers trying to gain more supremacy over the government, as opposed to sort of both of them kind of reinforcing each other. And then that again turned with Kennedy, and it just went off the rails kind of since then.
If we talk about the Trump presidency now, the Treasury Secretary from Wall Street and the chairman of the Economic Council from Wall Street are people that you worked with directly.
Right.
When you were in investment banking, what do they want?
Right. Well, I didn't work with Steve Mnuchin directly. He was there when I was there. We both actually left at the same time. So we occupied the same space. We didn't work together. I did work for Gary Cohn, and he was responsible, among other things, for the research department in which I worked. And again, we obviously went our separate ways. But the philosophy that those two men have is very similar to the philosophy that a former co-chairman of Goldman Sachs had back in the Clinton administration, who was Robert Rubin, who was someone who pushed this idea of competition, Glass-Steagall repeal, and everything else, because he believed that banks should have fewer regulations because that would make them more efficient and more competitive, and that would be good for everyone. And that was the argument that was sold and bought. Mm-hmm. So now it's not necessarily dissimilar. Steve Mnuchin has been talking about the idea that if banks are constrained, in particular, he points to community banks are constrained by regulations that will make them lend less. And I think this idea that we're trying to help community banks is lovely. I think we should help community banks, but he's not saying anything that would necessarily help community banks. I feel like he's using that element of deregulation that sounds very nice to and very sort of encompassing and competitive in a different way, having smaller banks compete, but to allow the bigger banks to have fewer regulations. I mean, there already are in Dodd-Frank a number of levels through which different banks have to produce different reports and so forth. It isn't like 100% that a community bank has to even do the same thing as a larger bank. And if you reduce regulations, all that will you reduce the minimum that you have. What that will just mean is that more bigger banks will buy more smaller banks, because I mean that's been the direction we've been going in this whole time.
I think they've absorbed
a lot of them. They've absorbed a lot of them. They absorbed, it goes in stages. I mean, throughout the century, that's what's been happening. It stopped a little bit in, right after Glass-Steagall. It kind of continued a bit in '55 and mid-'50s for different reasons. And there's always been a consolidation of bigger banks buying smaller banks. Where it really shot up was when Glass-Steagall, it shot up in 1994 when banks could go across state lines and do businesses across state lines, and so there was a lot of interstate mergers and acquisitions for bigger banks buying smaller banks. But they were somewhat constrained by the fact that smaller banks had more community ties and bigger banks didn't really want to deal with it. So even though it was happening, there was a little bit of self-regulation in the industry. But then in 1999, after Glass-Steagall was repealed, there was just a slew of bigger banks taking over smaller banks, and that continued. And we even have that now in the sector, where sort of middle banks are taking over smaller banks. The biggest banks have kind of done their thing, but it's now the mid-sized banks that are taking over the smaller banks. So if you deregulate that entire thing more, you're just going to actually force community banks to decide whether or not they're able to compete because of the fact that the bigger banks are taking them over, not because of a regulation consideration. And what Gary Cohn is trying to do is he's going after something else, which is an element of the Volcker Rule, which is part of Dodd-Frank, which was, I think, the compromise that happened in 2010 that sort of said, well, banks aren't going to be able to trade positions for their own books, so they won't ever be in a position where they're basically betting against their client. That came out of a Goldman Sachs situation, in fact, when Gary was there, and that became a $550 million fine to Goldman Sachs, that idea of being sued for trading against their own clients. And so that element, the Volcker Rule, was supposed to reduce that ability, and also reduce the ability of a bank to purchase hedge fund or private equity fund elements or have one on their book. And there's a lot of ways around that, and banks have done that, but still there was some idea of a certain amount of constriction on that, and that was, again, designed to avoid risk and the things that they had just been fined for during the financial crisis. What Gary's saying is that that constricts lending. So what he's saying is that it's the business of banks to make markets, and if they cannot make markets by buying and selling certain securities that along the way they have to keep on their books, then they're not going to be able to be effective market makers. Now, the top 10 banks in this country, top largest banks, control about 95 to 96% of traded securities. So, I mean, they're doing okay in the markets. And, you know, we discussed lending before and their own choices of restricting themselves by having excess reserve funds at the Fed. So, again, and there's other reasons why that's a false argument. But so they're both coming at different pieces of pushing the deregulation or the weakening of what we have, as opposed to doing the opposite, which would be advocating for Glass-Steagall or advocating for a full-on separation of banks that make markets and banks that do deposits and loans. And then there wouldn't be a need to discuss, again, this tinkering of regulations around the edges. So that's what they're not doing. Instead, they're basically using arguments that don't really make sense in order to push the idea of deregulating further.
Let me, to return to the article that you wrote, forecasting for 2017, you were discussing in there, if I remember it right, the international economic situation, not only in the United States, and you talked about the potentially combined importance of Japan and China for the world economy and for the United States. Obviously, they are countries which are both come directly with proposals, let's say, toward the Trump administration. They're also countries which usually strategically oppose each other. So how do you see that? What is the importance of this combined effect of China and Japan on the world economy, which you're otherwise describing as very unstable?
Right, so there's a couple things. First, in this whole evolution of central banks and the Fed and the ECB and Bank of Japan sort of coordinating their policies over the last post-financial crisis years, it created a situation where the People's Bank of China got very concerned. And they were very critical of this policy of cheapening money and quantitative easing, and the collaboration of the other sort of developed countries' central banks, and talked a lot about how there was hidden risks in that. And as a result of their criticism, they also began to elevate sort of their political position, because there were a lot of other countries, developing countries, that felt the same way, both in the Asia region and also in Latin America and so forth, who are also concerned that the Fed was sort of dominating currencies and monetary policy and the cost of money throughout, and they had to either figure out how to separate what they were doing in their own country, join with what the Fed was doing, or deal with how the international globalized markets would punish them. So China got annoyed by this, and as a result, they started pushing the IMF to include them in the as a reserve currency, in something called SDR, a basket of currencies, which before that point had just been the dollar, the euro. I mean, it had been the franc and the Deutschmark before 1999. It was basically just the dollar, the euro, the yen, Japanese yen, and the British pound. And those were the currencies that effectively lined the reserves of the central banks, and it was basically how liquidity was provided throughout the world amongst the larger countries. And China wanted to push into that, and so they used this sort of criticism and the instability that they discussed, not just them, but the IMF and others discussed the instability of the Fed policy, and ultimately pushed their way into the SDR. So now it is 5 currencies. And they came in number 3. So basically, in terms of the size of the weighting of this basket, it's the dollar, the euro, the Chinese yuan, and the Japanese yen, and the British pound. And they're almost the same at the bottom, 4 and 5. And so that was also a political push. It was monetary, it was political. At the same time, they were developing more trade alliances in the region with Russia, establishing the BRICS Bank, which was a development bank between Brazil, Russia, India, China, and South Africa, that would be purely run and used for emerging markets, which was kind of the newest of its kind. So it started to just champion a lot of external to the U.S. Types of things. And then as Trump was running, all of this was kind of still in play. And as he basically came onto the scene and started talking about a more sort of nationalistic, more isolated trade policy, and calling China a currency manipulator and stealing jobs and so forth, which he was not the only the Democrats also called China currency manipulator. It's in my new book. All the times that if something went wrong in the U.S. and China was blamed for it, even though they weren't necessarily related. But so China basically continued to develop alliances throughout the region. When Brexit happened in Europe, it basically stepped up, as the U.S. is stepping up to try and forge a separate relationship with the U.K. or to sort of start to map one out. It's trying to form separate relationships now with Mexico, because there's a sort of negativity surrounding our relationship with Mexico in the era of the Trump administration. So all of these things that started to shift because of central bank and monetary policy have sort of accelerated because of potential nationalistic or isolationist bilateral trade policy. How Japan fits in all that is that Japan has historical antagonism with China, but at the same time it's part of Asia. So you have a choice to make. They have a very strong relationship with the U.S. We're large trading partners. We're allies on so many different elements, including on the military side. The Bank of Japan was a staunch ally of what the Fed was doing during this entire, I call it in my new book, artisanal money era, since the financial crisis, and kind of moving along with what the Fed wanted. So it was playing that side, and it had to. At the same time, it's got this huge country next door that's developing all these other relationships in its region, and it really has to decide where survival is going to lie. And so there have been trade arrangements and agreements that Japan has made with BRICS countries as well as with China that have developed out of this sense of concern or uncertainty relative to what would happen with the U.S. relationship, as they've also been trying to maintain a strong U.S. relationship. And that just alters the shift of power and sort of trading money between sort of the West and the U.S. and the European bloc and what is growing in the area of Asia and Eurasia and the BRICS nations. And Japan, again, is sort of in this
but
middle component.
China is also offering the United States the Belt and Road Initiative, these large infrastructure, great infrastructure projects, and the Asian Infrastructure Investment Bank, which Obama didn't want to take, wanted to try to stop, but has expanded nonetheless. Do these make the U.S. The world economy more stable? Is this?
Well, I think it's a logical next point. I mean, China has criticized the U.S. policy for creating instability in the world, as have many countries. That has allowed it to have more regional trading blocs and to become more a part of sort of the international financial markets. That, in tandem, has allowed it to continue to develop its own infrastructure, and it has really good infrastructure. I mean, I was in China last summer for a while, and I took their high-speed trains from Beijing to Shanghai, and they're awesome. I mean, as are the high-speed trains, for example, in Japan, where the sort of distance from the airport to the center of Tokyo, it would take like 2.5 hours if you take a taxi or whatever. I try to drive that, but it's a very short, quick, pleasant experience on a high-speed train that also, it tells you where your gate is, and it has all sorts of boarding information, and it talks to you in different languages. There's a lot of high-tech stuff going on there from an infrastructure standpoint, and similar in China. So wanting to export that to the U.S. is a way to sort of take economic advantage, which is smart, of them to what Trump is talking about in terms of building infrastructure here. It just might be cheaper and actually more higher quality from a technological perspective to work with the Chinese on these initiatives in our country. And so then you kill two birds with one stone, right? So you have jobs that are created here because the work is physically taking place here, but you have engineering and design and plans and technology that's happening in China. And so from a Trump perspective, you're able to say you're not losing jobs, or you're not losing some jobs, or you're splitting jobs or whatever, which is not necessarily a bad thing. And China's able to add another growth area onto this whole pattern that it's undergone in the last 5-6 years.
You also said in that forecast that the Russian economy had turned around, started to grow, and you expected it to grow further in 2017. Obviously, many people have claimed the opposite, but I noticed that figures were, data was released today on, by the Russian government on neonatal health of mothers, maternal mortality, infant and child mortality, teenage mortality, all of these things showing, in some cases, fairly dramatic improvements, which could be put over against the United States data in some cases, of the same things, and to the disadvantage of the United States. But you said that you expected the Russian economy to continue to recover in 2017. What's the importance of that?
Well, again, it's part of a sort of diffusion of superpower sort of dominance coming from the U.S. or coming from the U.S. and Europe, because of Europe has, we haven't talked about, like, obviously a whole bunch of issues there. And again, a little bit of a Russia-China alliance as well in terms of trade, and in terms of the BRICS bloc and bank that I was talking about before. Last year, it was one of the best performing currencies, even during our election period, where we had a lot of disparaging comments coming from Hillary Clinton and the press about Russia. We had more positive comments coming from Trump, but the reality is there was a lot of sort of negative conversation in the United States press anyway. It didn't necessarily hurt neither the Russian market or the Russian currency, both of which had high outperformance. The currency certainly relative to other currencies, and the market as well relative to most other markets, even while we were talking about it, and even under sanctions that have still existed since they were put in place. So, it has been able to fortify its economy both foundationally. Its central bank has won, actually, and its the head of its central bank has won sort of best central bank of the year type awards over the last 2 years. The IMF has considered it a very stabilizing force, and so forth. And so its internal structure has stabilized, which helps its currency, which is why the ruble's done well last year, and I think will continue to do well this year. And also, it's developed itself all these different alliances outside of the U.S., because there is that uncertainty element. There was whether Clinton would have been elected, and to an extent with Trump, even though he has been positioned as having positive relationships with Russia and with Putin, and there's all sorts of noise about that. But the administration, the parties on both sides have more sort of negative views, so there's just uncertainty there. Even with all of that, Russia's continuing to strengthen its own economy and strengthen its alliances with Eastern Europe, with nations within Europe, probably with the UK, with Asia. And so that's going to continue, and that's one of the reasons, that diversification of its economy that has been positive, and that I think will continue. And we'll do even better if there is more positivity from the standpoint of the U.S.-Russian relationship, if that actually happens under Trump versus it's just sort of fought over. That will give it an even bigger boost. But right now, even without that, it's I think strengthening. It's still it's still volatile. Certainly when it's in the news and when it's being discussed in a negative manner, it does impact the market. We're in a sort of globalized news cycle and financial market situation. But still, in general, it has had and should have a positive trajectory for those reasons.
Tell us about the message of your forthcoming book. It's called Artisans of Money. You made a reference to artisanal money, which is a phrase I've never
Yes,
heard.
I made that up. Actually, my agent made that up, I should say. I should give credit where credit is due. I can't take credit. My agent came up with that term because we were trying to figure out, it's a book about what's happened, some of what we've been talking about now, but what's happened in the years since the financial crisis behind the scenes, in terms of what central banks have required from other central banks, whether that was through G20 meetings or that was through internal statements or through press releases or phone calls or whatever it might be, and just kind of divides geographically between Mexico and Latin America, Japan and China, and different elements of Europe, and sort of interweaves those relationships relative to the Fed, and how that not just manifested in monetary policy, so it was not just how these central banks were setting the level of rates and how they were trying to increase or decrease the value of their currencies, of course, in a wider market where lots of other players are involved, but also the changes that happened geopolitically because of that. So as I was talking about China, I believe that where China is right now, from the standpoint of its political rise, and its diplomatic rise, its economic rise, is very much related to the stance it took relative to the Fed. in terms of criticizing, and therefore having a reason and a sort of lifting point off to make different alliances with different countries. So it really traces
you
the
mean
ineffectiveness.
that it became the opponent of quantitative easing? Is that what you're saying?
To a large extent, it has its own. When I say quantitative easing is one component of what I consider to be artisanal money, or I consider central bankers to be artisans of money. Because they're not just setting levels; they're actually talking about full-on liquidity injections and taking money out of the market, and it's coordinated on a global basis in a way it's never been coordinated before for this long and so much geographically, which has had benefits sometimes and has also created a lot of internal issues within countries, fights between the Ministry of Finance and the central bank, for example, in Mexico and in Japan, cohesion between the central bank in China and its government. I mean, there's been certain ways in which policy's been adopted, but I think ultimately what the book does is it traces the ineffectiveness of the treatment of the financial crisis as just a starting point. It doesn't. I already wrote a book about the financial crisis. It takes a pillage. That's not what I'm not rewriting. What happened to Bear Stearns in March of 2008. But it basically says the ineffectiveness of dealing with that and the risky nature of the financial industry is what led to this mass period of artisanal money creation by central banks and their sort of rise as power players from a political and economic perspective, which is like well beyond their pay grade, and how that's manifested in a lot of political changes, whether that's a shift towards nationalism and Brexit, towards sort of anti-establishmentism in the United States, what it's going to manifest in terms of other elections in Europe and so forth. So it really sort of is this idea of tracing the activities of central banks through the shifts in the world since the financial crisis and where we're at today. In 400-ish pages. Maybe 5, I'm not sure. I've been asked to cut since I handed it in. So.
Thank you, NOMI PRINS.
Thank
and
you.
Good luck. We'll need it for our visits with Congress tomorrow. I've been talking to NOMI PRINS, author, historian of banking, expert in financial regulation, advocate as well. And this is Paul Gallagher of EIR, thanking you for watching LaRouche PAC TV.